Welcome to the Deep Dive. I'm John.
And I'm Wendy.
We're both on staff here at WeWire, and today we're digging into the analysis from this week's Stay Wired recap.
That's right. We want to give you a shortcut to understanding something pretty puzzling in global finance.
Yeah, it's this paradox.
Right.
Why is it still so expensive to send money across borders, especially for the people who rely on it the most? And the scale here is just immense. Get this core figure. In 2023, migrants sent about $656 billion to low- and middle-income countries, or LMICs. That's according to the Fed.
And the total global transfers, well over $800 billion. Just staggering amounts of money moving around.
And projections show this hitting, what, $900 billion, maybe $905 billion by 2025.
That's the forecast. So you'd think with all the instant digital payment tech we have now, moving that volume would be super fast and almost free.
I would absolutely think that. But the sources we looked at paint a very different picture.
They really do. And that's the paradox we mentioned. Despite all this tech, the World Bank says the global average cost to send money, the remittance fee, is still stuck. It's around 6.5 to 7%.
So let's break that down.
Yeah.
If you send, say, $1,000 back home,
You're losing $50, $60, even $70 right off the top, just in fees.
wow. Okay, so today we're going to unpack that. We'll look at the old systems that allow these fees to persist.
Right. And then the technology that's pushing back against them.
And finally, these sort of structural issues, the policies that are keeping that $50 or $70 fee so stubbornly high.
Okay, so let's start with why this money is so crucial. It's not just about the huge dollar figure, the $800 billion.
Right, it's about what it represents. This isn't just institutional money sloshing around. It's a lifeline.
Exactly. The sources are clear. Remittances are now one of the biggest financial flows globally. For many developing countries, it's more money coming in than foreign aid.
Sometimes even more than foreign direct investment, too.
Often, yes.
Yeah.
Combined, even. And this money directly supports almost 1 billion people worldwide.
1 billion people. And where does it go?
Well, the Fed notes this specifically for households, especially lower-income ones. It's the basics. We're talking food, housing, school fees, healthcare.
So it's not pin money. It's essential income, survival, really, for many families.
Absolutely. And if you zoom out to the country level, the dependencies, well, it's quite striking.
Yeah, I saw some figures that really make you pause.
Yeah.
Like the GDP dependence.
Oh, definitely. You look at places like El Salvador, Honduras, Nepal, Lebanon. Remittances make up over 20% of their entire national economy.
20%. Just think about that. 1/5 of the economy relies on someone working abroad, sending maybe a couple $100s home.
Precisely. So when you realize that, every single dollar lost to high transfer fees is a dollar that could have gone to food or medicine. It really highlights why these costs matter so much.
Which brings us right back to the problem. Why are these fees still so high? Why haven't they come down more? You said the average has been hovering around 6–7% since 2019.
Yeah, the latest figure for Q1 2025 was 6.49%. Barely budged.
So why? In such a huge market, with all this digital competition.
Well, the simple answer is that a lot of transfers still rely on older systems, outdated infrastructure. Specifically, the correspondent banking system.
Correspondent banking. Okay, explain that a bit.
Imagine you want to send a package internationally, but instead of one delivery service, it gets handed off between 5 different companies.
Okay.
And each one charges you a handling fee for their part of the journey. That's basically how traditional international bank transfers often work. Money hops between banks.
That sounds incredibly inefficient, like a series of toll booths. Wait, are you saying these huge systems like SWIFT, which handle trillions for big institutions, are also the bottleneck for, like, a migrant worker sending $200?
In many cases, yes. The underlying rails are often the same, and the inefficiency scales down, or rather, the cost scales down onto the small sender through markups at each step.
Okay, so where does the money actually go? Is there a breakdown of these costs?
Yeah, there is. A PwC analysis using BIS data gives us a pretty good look inside the bank costs for these traditional transfers.
Let's hear it.
Okay, so the biggest single chunk, around 35% of the cost for the bank, is just maintaining foreign currency accounts.
Foreign currency accounts.
They call them nostro vostro accounts. It's essentially the bank's own stash of foreign money held with another bank overseas and the bookkeeping required to track it all. You're paying for the cost of them managing these complex ledgers.
Wow. So over a third of the theory is just internal bank plumbing, basically. What's next?
Next up is the foreign exchange, the FX markup. That accounts for about 30% of the cost.
Ah, the hidden fee.
Often, yes. The bank gives you an exchange rate that's worse than the real market rate, that difference. That's their profit built right into the rate they offer you.
Okay, so 35% for accounts, 30% for FX markups. That's already 65%?
Right. And then there's compliance overhead, things like KYCML checks, which we'll touch on more later. That's another 15% or so, all passed on to the customer.
It really does feel like a regressive tax, doesn't it?
Mm.
Hitting migrant workers, small businesses, the people who can least afford it.
It absolutely functions that way, and the research confirms it. When fees are high, people tend to send money less often, or they send smaller amounts. They have to, because the fee eats too much into the actual amount received.
And globally.
Yeah.
What's the impact of shaving these fees down?
It's huge. The UN and the World Bank did the math. If we could just cut the average fee from that 6-point-something% down to the UN Sustainable Development Goal target of 3%,
Okay.
that would save families receiving remittances about $20 billion a year, globally.
$20 billion. That's incredible.
Yeah.
That's $20 billion more going directly into households for essentials, bypassing aid budgets or anything else.
Exactly. It's pure purchasing power currently being lost to friction in the system. And remember, these costs vary wildly.
Right, like the U.S.-Mexico corridor. That's massive.
Huge. And a study there showed average fees just under 5%, still above that 3% target, but better than the global average.
But in other places.
In some corridors, especially involving parts of Africa or the Middle East, fees can easily top 10%, often because of those opaque FX markups layered on top. But, there is good news here. Technology is directly challenging these old, expensive ways of moving money.
Right, this is where the fintech disruptors come in. Companies like Remitly, Wise, Zoom, they operate very differently.
They really do. They basically bypass a lot of those bank-to-bank hops and the delays you get with systems like Swift.
How do they manage that?
It's pretty clever, actually. They use pre-funded accounts. They hold pools of money, their own liquidity in both the sending country and the receiving country.
Okay, so they have reserves ready on both ends.
Exactly. So when you send $1,000, they don't necessarily wire your $1,000 through 5 banks. They can just debit their account here, credit their account there, and pay out locally almost instantly. They net out the flows internally.
So much less friction. And the cost reflects that.
Massively. Digital remittances through these services often cost only 2 to 5% of the transfer value.
2 to 5%. Compare that to what?
Traditional bank wires can range anywhere from 4% to sometimes even 18% when you factor in everything. It's a huge difference. That's why these digital players have grown so fast.
Makes sense. And what's next? What's on the horizon?
Well, beyond the current fintechs, you're seeing blockchain and digital currencies really starting to enter the picture, particularly stablecoins.
Stablecoins, the digital tokens pegged to regular currency, like the dollar.
Right. Their issuance has exploded, doubled in the last 18 months or so. There's about $250 billion worth of them out there now.
And how do they help with remittances?
Because they run on potentially faster, more efficient digital ledgers, they can allow for things like 2047 settlement. Payments clear almost instantly, any time of day.
And compliance. Can that be built in?
Potentially, yes. Automated compliance checks could be integrated. Fed officials have actually noted that some dedicated stablecoin networks are already starting to reduce fees and speed things up in certain corridors.
Interesting. And then there are CBDCs, central bank digital currencies.
Yes. Government-issued digital currencies. We're seeing trials specifically for cross-border payments, like China's ECNY or the Dcash project in the Eastern Caribbean. The potential is there for even more efficiency.
Okay, so we have the fintechs already cutting costs significantly. We have stable coins and CBDCs potentially offering even better solutions. Why are we still talking about a 6.5% average fee?
Because technology isn't the only piece of the puzzle. There are major structural headwinds. The G20 and the Financial Stability Board call it the compliance maze.
Fragmented regulation. You mentioned this earlier. Break that down for us. What makes compliance so tricky that it blocks good tech?
It really comes down to different rules in different countries. Think about KYC, know your customer rules. Proving who you are.
Right, identity verification.
Every country requires it, but they often demand slightly different documents, stored in different ways, following different privacy rules. Same goes for AML, anti-money laundering checks.
So if you're a payment provider, you have to basically build a separate compliance process for every single country you operate in.
Pretty much. You have to duplicate checks, navigate varying data privacy laws, data localization rules. It all adds up.
Adds complexity, adds time, and definitely adds cost.
Exactly. And here's the really frustrating part. It can lead to something called de-risking.
De-risking.
Yeah. Big established banks might have the resources to handle this complex global compliance burden. But smaller, newer fintechs, the ones with the innovative tech, often don't.
So what do they do?
Sometimes, for smaller, high-risk, or just complex corridors, it's easier for them to just pull out, close the accounts, stop serving that route.
Wow. So the tech exists to make things cheaper, but the regulatory patchwork means it can't actually reach some of the places that need it most.
That's the crux of the problem. Policy and regulation haven't kept pace with the technology.
Okay, so if these structural issues are creating such friction, how does that play out in the actual currency markets?
Yeah.
Especially for countries that rely heavily on these remittance flows. Let's quickly check the Stay Wired FX corner from the recap.
Sure. Globally, there were a few key things this week. Brazil's central bank held its main interest rate, the Selic, steady at 15%.
Okay.
In the UK, the 10-year government bond yield dipped a bit, partly on hints the Bank of England might ease policy down the line. And maybe relevant to the tech discussion, NVIDIA's CEO, Jensen Huang, gave a warning. He suggested China could potentially win the AI race, partly due to factors like energy costs and regulations over there.
Interesting point. But let's zero in on the FX Africa corner. This ties directly back to remittance stability, doesn't it?
It really does. Take the Kenyan shilling, USDCS. It actually saw a tiny bit of appreciation this week, about 0.08% stronger against the dollar.
And what supported that?
Two main things, according to the sources: stable foreign reserves held by the central bank, and crucially, strong remittance inflows. A clear example of that money acting as a buffer.
Okay, what about Nigeria?
The Nigerian naira, USD-NGN, saw a bit of a recovery, strengthening about 0.35% over the week. That was mainly attributed to ongoing interventions by the Central Bank of Nigeria to support the currency.
And Ghana.
The Ghanaian cedi, USD-GHS, unfortunately weakened further, about 1.70% week to date. It's still facing significant pressure, down around 41% against the dollar since the start of the year.
41%. That really highlights how currency volatility can erode the value of those remittances when they finally arrive home.
Absolutely. It directly impacts the purchasing power. And quickly on commodities, oil prices stayed fairly strong. Brent crude was trading around $89 to $91 a barrel, mostly OPEC plus supply discipline and ongoing Middle East tensions supporting that.
And gold.
Gold was a bit defensive, trading roughly between $2,360 and $2,390 an ounce. A stronger U.S. dollar and slightly higher U.S. bond yields seem to be weighing on it after some mixed jobs data.
Okay, so let's tie this all together. We have the technology, we see the market movements, we understand the cost structure. What's the main takeaway?
I think the core conclusion from all the sources we reviewed is pretty clear and maybe a little frustrating. The technology to make remittances significantly cheaper exists right now. Fintechs are doing it. Stablecoins could do it. CBDCs might do it even better. The innovation isn't the bottleneck.
The bottleneck is?
It's the alignment, or lack thereof. It's getting global policies, regulations, and those old legacy financial networks to catch up and work together smoothly.
So until those structural barriers like the fragmented regulations we talked about are addressed.
Sending a $1,000 home is still going to cost you maybe $50, $60, $70. It feels like just watching that money disappear into the system instead of reaching the family that needs it.
Yeah. And when you think about the scale again, that $20 billion in potential annual savings, it's not a small problem. It's a massive global inefficiency.
It truly is.
Which leaves us with a final thought for you, our listeners, to maybe ponder.
Given everything we've discussed, if world leaders could wave a magic wand and implement just one global regulatory change tomorrow to finally push that average fee down towards the 3% UN target, what would be the single most effective move?
Would it be creating truly standardized global rules for KYC and AML, simplifying that compliance maze?
Or would it be more effective to directly regulate and cap those hidden FX markups, especially in the most expensive corridors?
Which lever pulls hardest? Standardizing the rules or capping the price directly?
Something to think about as this space keeps evolving. Thanks for joining us for this deep dive into the weekly Stay Wired content.
Catch you on the next one.
Stay Wired Weekly Recap was produced by WeWire,
a B2B company, bridging the banking gap between emerging markets and the world.
Tune in same time next week for the Stay Wired Weekly Recap.